Now, before we get into this, we'd like to remind you, please like, share, subscribe. We have a lot to cover, and we're trying to go as quickly as possible to, be respectful of everyone's time. So when we look at poverty rates, we've talked about poverty abroad. Well, let's talk about poverty in America. And this was a great statistic from University of Chicago and Notre Dame economists, where U.S. poverty rate increased by 2.4% in the later half of 2020. Nearly double largest annual increase since 1960s. An additional 8 million people are now considered poor. So if you think about how quickly we've kind of reversed this move, and now we see additional pain coming into, again, that poor section of the economy. And now when we talk about inflation, and as we talked about with Philly, with Dallas, with PMI in general, we're seeing this large incremental move in inflation and prices paid, but yet we have way more people and the average growth is not something that we haven't seen since the 60s. Again, this is where we keep coming back to how bad could it get when we consider spending, when we consider how quickly can people come back alive and around when we have this pain. Because, look at how the market expanded pretty aggressively from 2016 to 2018. And how much did we lose in terms of people that were defined as under poverty? Now we've taken back essentially all of the gains we've had since 2018 to 2019 into 2020, just as we're coming into a very slow recovery, and that has really been fed through stimulus. And how you can't keep stimulating forever, you have to let some normalcy come back in. So is this a changing trend where we're going to see this actually go back to levels from 2015? And if you think about the pain on the working side, as inflation ramps up, as Powell said he's okay with inflation sustaining over 2% for quote unquote some time, well, these people will be impacted the most. Again, coming back to social immobility, the inequality that is in the market that is generating a lot of these problems that we continue to see in the open market, in these riots, protests, all these different components. This is, I think, a big part of that, and is something to be watched as we go forward, especially because we had such a large increase that we haven't seen since the 60s, which is creating the Consumer Confidence Board. And we look at household income. So this is the lowest level of income that's mapped. And you can see this massive drop off from 130 down to about 65. And it's the lowest it's been going back to this 2014. This is going to be a big problem. Is there's no real confidence in the market. If there's no confidence in especially this part of the market, you're not going to spend. You're going to try to save. You're going to try to do as much as you can to try to preserve some form of capital heading into an uncertain future, if you will. And then when we take that and look at the labor market situation, so jobs hard to get is starting to go back up. If you think about, these jobs hard to go to get in general with the U3 unemployment rate, again, we're starting to see this kind of move up in this gradual component, which is where we think this U3 unemployment rate is going to continue to trend as the jobs are getting harder to get. There's two ways to look at this, because they could be hard to get because there's a lot of competition. If there's a lot of competition, then how long do you stay out of work? If there's more competition, well, what salary are you willing to accept? And then that's where, again, we kind of come down to, well, is there just not a lot of jobs available? And so if there's not a lot of jobs available, that means that you're going to compete more aggressively, and the unemployment rate will remain elevated and kind of track this level. So this is going to be something to watch that I think is an interesting way to look at the labor market situation, again, harkening back to what we've seen in terms of the rise in poverty in general. So then when we look at, okay, number of children under age 18 in the U.S. as a percentage of the total population. So this is what we're looking at in terms of, well, can people have children? How poor are you? How much money do you have to afford a child? And we need to see this trend change if we don't want to have a population problem in terms of the age of the general U.S. population. We need to see the age move. It has to stay I think it to be an expansionary territory, and I could be wrong, but I think it's like 2.3 or 2.4. It has to stay above the average of 2.4 children in coming into existence in order to maintain a positive growth of the population. And you can see in 2020 we're at 22.2. So we're again coming down, and it's just we need to adjust that unless we're going to fall into a China trap. What's happening in Europe, what's happening in Japan the most aggressively. So again, this is going to be something. But if you don't have money, if there's no jobs, if you can't move forward, as we talked about in the last segment, where the wage growth just hasn't been there, and since 2000, going back to 2020, 2019 from the Bookings Institute. Again, these are things that are going to limit just how healthy is the economy on the other side. And then when we look at let's look at consumer confidence in the S&P 500. So the gap continues to widen, and that's where, again, gravity is real, and at some point it will matter. And at some point, your guess is as good as mine. But after watching GameStop and all these other high flyers, as we're sitting here talking with GameStop up 132% at 343. Okay, so again, we see this weird degrossing as, the S&P 500 is down 100 handles, and you have some of these things up 100 plus % in just a day. Again, the market is not healthy. It just isn't. And when does the game end? When does does the game of Russian roulette lead to the inevitable? I would think it's sooner rather than later. But again, here we are trying to figure that out and help you with some of the data points that we see that are very interesting in general. So this is looking at that Philly Fed, again, trying to tie these two back together. So when we look at the outlook, the Fed business outlook, it's gotten a little bit better, but the diffusion index for the number of employees, it's gotten, again, moving up, but not keeping pace as we see some of these slowdowns. And just what we're seeing from Dallas and some of these other Fed components, like the New York Fed, the WEI index that we've talked about, has moved lower again. Again, there's some pain that's being priced into Q1 that I think some of these leading indicators, it's not happening across the U.S. It's happening in different pockets, but it's still weighing down on the general activity given the inflation side of the equation. So we talked about the Philly, but now let's look at Dallas. So Dallas has seen level of general business activity decline, and the Dallas Fed manufacturing outlook for number of employees still up but declining. Again, this differentiating factors in terms of who is getting jobs and where. But U.S. existing home sales month over month, still maintaining this height. So again, the reason why we're rehashing this in a different segment as well is because you have to think about, okay, well, we have a wage problem, we have a job problem, but yet you have existing home sales where they are. So how can this really have legs if we've seen the first movers gone and now we are into kind of that back end of, is there this second wave as we look at U.S. existing home sales? And our answer would be no. But again, we have to let the data prove itself out. So when we start looking at, what is happening in the market, when we start looking at rates and what's movement, like this is looking at the 10-year note leverage funds. And you can see that now we're starting to see people starting to play the curve a bit. We saw some bearish setups where they were buying puts in the 10-year. They were selling calls in terms of, and the idea that you were going to get a price move decline and you were going to get rates going up. And now as we look, the pain is continuing to come into the market and you're seeing this movement of dollars. So then when we look at the 30-year, 5-year government bond spread, we are seeing the bond spreads going up. And again, this is something to consider when you're looking at what is the fear overall, where are we seeing some steepness, what is that steepness going to do as we look at the borrowing side, going back to segment 1, when we looked at the G7, what does a rate shock look like? What does the steepening look like? Can we see these components? Yellen has talked about 50-year bonds. What does that 50-year bond look like? Where are things going to go over the next few months as we continue to see an easing standard? But I think that Europe is going to be the one to kind of be in that driver's seat. Euro is going to be the driver, and I think they're going to try to drive the euro down. Does it go to 110? I would love to see that. I don't think it's likely, but 115 is, I think, something they're way more comfortable with. And just given where the setup is, where the shift is, the Fed is going to continue its buying spree. So you're going to continue to see these purchases of U.S. debt, and that's going to create that inherent bid for dollars. And I do think the dollar is going to be pressured to the upside over the near term. And this is, again, looking at the U.S. 5-year break-even rate, you're seeing it continue to push up. Again, the sharp move off the bottom, taking back those 2019 lows as we continue to see that break-even rate going up. And as inflation starts to tick up, again, you have to cover inflation for that break-even rate. Like, what is break-even? It's nominal. It's the nominal rate plus inflation. So you want to be at, so you need to, real rate, because you want to look at the real rate, and then you have to, again, factor in that inflation component to get to where you need to be to say, look, this makes sense. I'm covering not only, I'm going to get interest, but I'm also going to cover inflation. And these are the components that are missing, which is why we think that you're going to continue to see some of these rates pressured to the upside. But again, if you have an increase in demand, you might think, well, you're increasing demand, so your prices should go up because there's going to be more competition. But if you're increasing supply, then the supply is going to offset the additional demand. And again, this is why it's a very complex situation that we try to simplify, because there's so many moving parts that are going to impact where things are moving and how things are going, and the health of the underlying economy remains the biggest risk here as they try to manipulate different components. And you always have this kind of this fallout of what comes next. So, well, what comes next? And I think this is where we start to pivot to, how is the consumer changing? So remote workers say no commute and flexible hours are some of the benefits they've experienced while working from home. So when you look at 68%, 63%, have been saying no commute, flexible hours is the biggest benefit. Again, thinking about how does this look on the other side of COVID? And again, that we keep using different data points. We keep using different surveys, because this is so important of what are the surveys saying. And the surveys continue to say this is something that is going to continue to move in this direction. And, the ability to do small household tasks while working, ability to dress more casual, all of these things are benefits of being home. But there's a dark side to it. Remote employees say it has been challenging to balance work with home duties and maintain relationships. Balancing work with home duties, maintaining relationships with colleagues, distraction from families. This percentage is why we're never going to go fully remote. There's never going to be a pivot to, I can be home 100% of the time. And some people can. I am not saying they can't. Some people have that fortitude to separate that, but others don't. And I don't. I have an office here, even though my kids are home, and it's just because I wouldn't get anything done if I was at the house. So this is something where we're going to see that flexible schedule. How flexible is going to be a much bigger component. And as anybody who we on this call, our producer, our associate, everybody has issues with the key technical issues. And it's not even just technical issues, it's just a matter of internet. So how much can you actually get from the internet? How much can the actual infrastructure support? Again, coming back to that blended side. And now when we think of, again, what are people going to do with this money? So this is, again, looking at the same component, looking at it a little bit differently. So we're saying that this is going to be normal. You're going to see more flexible scheduling, but more than 1/3 of Americans say they will pay bills if they were to receive $1,400 stimulus checks. Again, these are the components that we saw earlier. Pay bills, 35%. Put in emergency savings, 15%. Pay toward debts, 12%. That's where we're going to get this de-risking, if you will, where you're not going to get it pushed into the market, because The first one, you had people buying stuff, trying to get out there, putting that money to work. This money's not going to go to work the same way. You're paying down a bill, you're deleveraging yourself, but you're not generating that velocity of money. You're not putting in emergency savings. The banks aren't doing all that much. Again, paying debts, it's going down to debt destruction. You're not seeing that cycle going through, which has been the problem. So even though consumer behaviors are going to change with more people working from home, the way they're going to disseminate this cash is also going to be different and needs to be considered when we're looking at that economic balance going forward. And this is just looking at the initial claims of unemployment. So again, we continue to see this elevated initial claims, and the pandemic UAE initial claims. Again, everything remains at this elevated level. Pandemic unemployment assistance remains elevated. That got renewed. That got kicked out for another 6 months. We're going to continue to see this factoring in. And you can see that we're moving in the wrong direction as we go through initial claims. Again, as we look forward, we think that we're going to be above estimates for tomorrow in terms of where those initial claims will be. Total excess personal savings in the U.S. reached $2 trillion by the end. So again, with the additional checks of the 1,400. So this survey, this analytics is saying that we're going to get a big increase in terms of the additional 1,400 into savings. But that's why we keep talking about the fact that people still aren't working. A lot of unemployment, so you have bills to pay, and the bills have been piling up. So are you going to take that money and put it into savings, or going back to the survey we talked about, are you going to pay bills? 35% of them say yes. Put into emergency savings is 15%, and 12% paid toward debt. So we're talking about 47%, and again, given like this is a sample size, you don't know what it is, but 47% are saying that they're going to pay down debt. So it's hard to say that we're going to get this big increase in excess savings, especially, and we talked about it in previous shows. The lower quartile has to pull money out faster, and because they have their expenses are going up, as we talked about with inflation and other types of pain. So this seems a bit excessive, but again, it's just a forecast, it's estimates, and it's something where we think it's going to surprise to the downside, which will put some lid on where some of that economic growth can go. Coming back to change in small business open and hourly employees working since January. Businesses open is flatlined at a lower level than December. Again, pain continued, and employees working is well below where we were in the holiday season. You do have, again, this is going to come down to two different things. Businesses open, a new low, versus normalized for holiday. So new low from where we were in January, and employees working, which just means that we've had a bigger than expected, because it's the 7-day moving average. We've had a bigger step down where the seasonal employment is gone, and now employees working is lower than where we were. The trajectory is that full rollover. Now, we don't think this continues to roll. We think we just flatline here, and it comes down to the bigger issue in terms of where this pain is in general. Now, as we've been talking, a headline just came out saying more than 6 million added to food stamp rolls as pandemic surge. USDA releases data on jump in assistance through September. Trump administration delayed data, citing technical glitches. So more than 6 million Americans went on food stamps between February and September of last year as the pandemic-induced economic slowdown pushed more families into poverty. Coming back to again, I don't know how many times I can try to say this or say it in different ways. There is going to be a problem, and jobs and spending will be the biggest case. Now, it doesn't mean that we won't try to do more. And it's because we will see people going out there and trying to generate more activity. And this is another interesting way of structuring a new entity. And this is from this blog here, looking at just the backdrop of hub and spoke. So once the pandemic is over, what office model will your team choose? You have a hub and spoke where you're just going to have a bunch of satellite offices, obviously fully centralized, and the primary office. So fully decentralized in the primary office. The biggest difference is going to be this hub and spoke and fully decentralized. These are the two that we think, or I think the most, is going to impact long-term gasoline demand and those shift as people don't travel as far or have to rely on that primary office. Instead, you're going to have a bit more of a local feel in terms of local movements. And then fully decentralized just means you can be anywhere and you can tie into where your computer is a dummy box and you're actually pulling down from the cloud. So when we take that to the next level, well, in 2021, if you were to start a company today, where would be the most beneficial place to found it in the interest of the company's long-term success? Distributed or remote is that 42.1%. This is, I think, the biggest component of what does that decentralizing look like? What does gasoline demand look like? What does energy demand look like? And how do we actually factor in that long-term shift to flexible schedules, permanent schedules, and that work from home? Where if I work in a decentralized company, but I still need an office just given that's how I focus. So I went out and I were able to get an office and it's 12 minutes from my house. So in the past, I would have to go to Manhattan. I would have to be on a train for an hour, or I'd have to drive in rush hour traffic. Or this office is going the opposite way of traffic, 12 minutes away. Again, just how does that shift happen? Again, I'm anecdotal where we're trying to look at the data in general. But when we look at, again, the wage survey, the U.S. wage survey, we're seeing this disconnect of of wages faltering into end of 2020. And this is what we continue to see coming through. This is looking at consumer, Conference Board, Michigan, manufacturing, small businesses. The small businesses, this is all being picked up. And the pain continues to drift to the downside. Again, wages going down, inflation going up, tightness in money. But when we look at how our credit and debit card spending at restaurants changed, this is, again, the shift remains in delivery. People are not going there. They're getting it delivered to their homes. And when we look at unit labor costs tend to lead U.S. core inflation. So unit labor costs are going up. And this is why, again, core CPI is going in one direction. How quickly, how fast, where does it go in general? Where does it end? It's going to be in one direction generally in terms of how quickly, again, we see this pain in general. These are the issues that we continuously see. And the U.S. is not the only one. And now we're going to shift a bit into Europe and look at how Europe is facing, if not even worse situations than the U.S., as they look to try to get to the other side of this just economic hurdle, if you will.